Grow your wealth and diversify your investment on unit trust via the HSBC Internet Banking. Here's how you can invest instantly. Log on to hsbc.com.my/UTB. You'll find more than 80 retail and wholesale funds to choose from, so you can diversify to manage risks. You can even invest in both local and foreign currencies. Buy, sell, or switch anytime you like. What's more, you can make fun comparisons with regularly updated market insights. With everything HSBC has to offer, you have total control to diversify your unit trust investments online the way you want it. So invest with HSBC Unit Trust via your HSBC Internet Banking easily today.
Allion, at your service. The global markets, especially the US Foreign Trade Index, is open. More opportunities to invest, more choices. Did you hear about the good news? Check out how much your holdings have grown since the last investment. Great job! Whenever you're ready to make another investment, you can easy invest with just a few taps.
Hi, what's with the big smile?
It's just my wealth planner. This one is with me all the time.
Your personal wealth planner now on mobile. Stay ahead of your finances in just a few taps with Wealth on Mobile. Now available in the HSBC Malaysia mobile banking app. Invest easier and smarter with Wealth on Mobile. Download today.
Hi, good morning, ladies and gentlemen, and thank you for dialing into the second installment of HSBC's exclusive quarterly FX market outlook. Here with us today is Mr. Marcus Chia, who is our Treasury Specialist within HSBC Malaysia. A brief introduction on Marcus for those of you dialing in for the first time. Marcus joined us back in 2014, and he has amassed more than 10 years of experience in global markets and FX advisory. Having graduated from University of Warwick, Marcus holds a Bachelor of Engineering degree, as well as the relevant financial market licenses. For today's session, we will focus on the factors that underpin FX rates and their implications on the global economy. We hope that this session can help you better understand how you're able to use FX as a form of diversification and hedging tool to support your wealth goals. Now, I'd like to pass the time over to Marcus. Marcus, take it away.
Thank you, Kimberly. Thanks everyone for joining in today. So what I'm going to do is I'm going to try to spend 15 minutes to explain a little bit about how we view what's unfolding up in the markets. I think forecasting for FX and other asset classes is kind of murky at this present point in time because so much is driven by sentiment and geopolitics. But we're going to try to bring you back to what we view, the way we view things, how we interpret it, and hopefully you everyone can find some kind of understanding and come to your own conclusions yourself. Okay, so to start off, let's look at the temperature of the world right now, based upon the derivatives in the open market, how people are positioning their money. It seems like the world overall is rather fearful. So with this, you have an idea that not all fundamentals will be having a larger gravity on asset prices because people are fearful. And it's also because we don't know what's going to happen 1 week from now. We're not too sure what exactly Russia is going to do. Will there be nuclear weapons involved? Will there be more natural disasters, for example? So people are positioning their money into safer assets, mostly into money markets, government bonds, and generally liquid assets. And among all of them, usually will be US dollars. So to give you an overall view of what is causing problems for our world right now, why aren't we in the rosy growth phase? Why isn't everyone happy? Why is there so much worry out there? It's actually a legacy of our coronavirus that we had for the past 2 years. So in the past 2 years, we had lockdowns, restrictions. According to IMF, the past 2 years, we've had 7.3% GDP shaved off from our global economy. And mortality was high at its peak. In developed countries, it was 10%. In developing countries, it was about 34% mortality rate. So all this definitely caused havoc to our supply chain, which brings us to the heart of our problem right now, which is inflation. So inflation generally is something that we actually do desire, but at a limited pace. Most countries would prefer it is up 2 to 3%, because inflation implies that you can charge a premium for your goods and services. There is enough demand out there for you to actually make a profit on your business. So it's not true that we want to avoid inflation at all costs. We just want it to be at a very manageable level. The problem now that we face is that thanks to the coronavirus, the supply side is facing a lot of constrictions, whether it's logistical or it's actually, say, mining or farming or whatnot, right? We don't have enough supply for the rest of the world, which we still have a growing population. So as a reaction to all of this inflation, countries must, or they nearly always raise interest rates. Usually, sometimes you may want to manipulate your exchange rates, but most countries use interest rates to actually curb inflation. So when inflation rises, a country usually raises interest rates to make business and operational costs more prohibitive, so people will scale back, and then inflation will therefore fall. But the problem right now is that we have a supply problem, which has been aggravated by lockdowns in China, which is, well, manufacturing hub of the world and whatnot. They have the largest ports in the world, so a lot of shipments, logistical shipments, have been impacted thanks to China shutting down. And of course, we also have the ongoing problem of a war in Ukraine right now, or as Russia likes to call it, special military operations. Russia is a huge exporter of energy, particularly natural gas towards Europe and UK. But to a lesser extent, you may not know, they are actually a huge exporter of grains, particularly to Eastern European countries and African countries. So with so many sanctions placed upon them, you definitely will see a rise in prices of energy and grains. India, this week itself, also stopped exporting grains because of wheat in particular, simply because they do not have enough for their own population. So you're going to see this pattern continue on for the rest of the world. And countries have no choice but to raise interest rates because you need to cap inflation. If inflation runs away from you, it's nearly impossible to bring it back down. Give an example, a can of Coke 10 years ago was 80 cents. Now it's nearly 2 ringgit on the shelf. And you're not going to see 80 cents ever again. It's nearly impossible to. It's more likely to go upwards than to come down ever again. So countries have a huge pressure, even though they don't want to. They don't want to kind of slow their growth. They need to raise interest rates. And with that, when you make interest rates higher, it's cost of funding for your housing loan, your car, your business, all goes up. And therefore leads us to this point in time. There's huge fear for recessions over in the US, in the UK, the rest of the world. So the big word that has been thrown around quite a lot nowadays is stagflation. We have stagnant growth. We do have slowing growth in the world, and we have high inflation. So that's a term that is being bandied around quite a lot at this point in time. Okay, so what do we view, or how do we view the world? We actually downgraded our global growth forecast for this year to 3.4%, while upgraded our inflation forecast. That's how bad things do seem to us at present. So GDP is one of the most basic terms we use to gauge the strength of a country. What it means simplistically is goods and services produced in US dollars by that particular country, because that's the best way to gauge whether a country is strong. If you're going to kind of gauge a corporate, right, you're going to kind of gauge how much profit it actually produces. So similar to a country. So the goods and services produces essentially their profit. So we do expect things to slow down, activity to slow down for this year itself, and maintain that it will be sluggish but still growth for the next year. Okay, so among all this, all these countries, you see probably US dollar being the most resilient among all of them, with still rising interest rates, unfortunately. So that's why they're on an interest rate path. In terms of interest rates itself, the US right now is 1%. I think it's impossible to talk about FX without talking about the US dollars. So much of transactions is in US dollars, whether you're talking about equities, bonds, treasuries, or currencies itself, daily transactional currencies. It's nearly predominantly in US dollars. So we have to address the US dollars. So right now it's 1%, and we expect it to go up to about 2.5% by end of this year, which is another 1.5% more. For the Reserve Governor, Jerome Powell has really said that they will raise it by 0.5% in the next 2 meetings, which is in middle of June and the end of July. So that's going to happen, and that will actually cause havoc because treasuries is something nearly all governments hold, and loans in terms of US dollars is something all governments hold. So to service that would be a lot more onerous for us going forward, where the US gonna go with their plan to raise interest rates. Well, in Europe, the biggest problem for Europe has been that they refuse to talk up interest rates. They've been trying other ways like tightening, but they understand that raising interest rates is prohibitive to growth. For example, Malaysia, the largest proportion of GDP is SME, and you're gonna make it a lot more painful for businesses to operate if you actually raise interest rates for them. So usually you don't want to do that. You want your SME to be booming, right? But we have no choice because inflation is rising. So one outlier for us is the UK. I think if you've been following us for years, we've been one of the most bearish on pounds. So the market right now is pricing in 133 basis points of interest rate hikes for the rest of the year. But we only think that they will raise it maybe 0.5 percentage points for the rest of this year because of growth issues. And over in Australia, on Tuesday earlier this month, they raised rates by 0.25% from 0.1 to 0.35. We feel that they will raise it to another 1% for the rest of the year. So that is in terms of interest rates, our expectations for these major countries. So countries have no choice but to raise interest rates, even though they don't want to. So in summary, I'm going to give you an overarching view first before I carry on and justify some of the points that I made. We do feel that the dollar will be stronger for longer. The persistent geopolitical tensions is still very, very evident. No resolution or not even de-escalation happening over Ukraine, Russia. No new outreach by China. And we have all the rest of the other problems that are happening in the background, which we don't pay so much attention to right now, like Brexit. Okay, so all this is still ongoing. There's still supply disruptions. There's no sudden change in supply. And the Federal Reserve being very hawkish is all telling us that the USD will remain pretty strong going into the short term and down the line. It's not going to drop off the rock by 5% in the next day or so. The two things that would change our view for HSBC is that suddenly there's a sudden spurt in global growth, or there's a U-turn in the Federal Reserve policy, which we both do not foresee coming about. So the main winner ought to be US dollars. Okay, and I'm going to go into the countries by itself right now. So this is something of a one-pager for me. If I were to present to someone, right, and I want to make it concise, I'll actually skip this one single page. So with it, I'll give you a chart which shows you past performance. So you can see here, dollar has been coming off from its highs. It hit 2-decade high last week, and then it's been coming down for the past 4 days or so, or 4 sessions or so right now. And that's very specifically thanks to a recession or fear of a recession recently in the market. One night, their retail sales came out as 0.9%. So in red, it means that it's just down from the previous session, but 0.9% rise month to month is very respectable for the US. For the US, jobs and wages and consumption is very important because consumption makes up about 70% of US GDP. So with that number, even though it was slower than the previous period, it still made people a lot more comfortable. It hinted that Americans were willing to dip into their savings and spend. So that's why you see risk appetite actually rising up again today for the 4th session in a row. So looking at the other data, which we use to gauge the strength of the country, is quite insightful. So 3.4% first quarter, the US is slowing down like the rest of the world and like we expect it to, but inflation remains really high. In March, it was 8.5 and now it's 8.3. It's just extraordinarily high. Imagine that, say, if your wage rose this year 3.4%, but inflation was 8.3%. So your real wages itself is actually falling. And all this inflation is just essentially a lifestyle tax on everything that you can spend on. It's just onerous, you don't need it, and it's painful, and it makes life a lot more difficult for you. So no one ever wants inflation or inflation higher than your wages in their lives. So with this is why the US is raising interest rates. It also helps a lot of retirees save a lot more. And it will continue on for the next 2 meetings, 0.5 percentage points. So among all the economies that are functioning right now, facing inflationary pressure and slowdown, the US seems to be one of the most resilient, and thanks to their resilience, they are willing to raise interest rates right now. So overall, data coming out from the US seems pretty good. PMIs, I want to explain a little bit. A lot of times, a lot of countries want to express PMIs. You will see read the headline news, right? They will say PMI. PMI is a forward-looking indicator, and that's why we use it so often, as opposed to calculating direct output from your industrial production. So PMI is Purchasing Manager Index. It's just a survey sent out to all purchasing and hiring managers, asking them whether they're actually expanding, renovating, hiring, and based upon their response, they put it into an index. If it's above 50, it means that they're expanding. It means it's growing at a faster pace, accelerating. So both manufacturing and services are accelerating, despite services being in the red. So you can see the economy still looks healthy looking forward. And if you look at the other causes why we believe that the US dollar should do well, is that in a slowing global economy, cyclical just means relative to economic growth. So anti-cyclical means slowing down of growth. And the main winners usually are dollar, the Bloomberg Dollar Index, and the Japanese yen. So it's one big reason why we are saying what we say now, that USD will benefit. And today itself, you can see this is US Treasury yields, US Treasury bills and whatnot. This is pretty important because it does give you a flavor of the sentiment in the market. So Treasury yields rose, net change overall positive. It means people sold off bonds because they think that interest rates will rise higher. And this then gives us another reason why the market's functioning the way it is. So the 10-year US Treasury note is considered the international risk-free rate of return. So it is literally the time deposit interest rate benchmark you use if you're going to invest, right? So 2.95 is the return that you receive if you invest in this note. And this is a problem right now because the average returns from equities is actually not up to scratch to treasury yields. So that's why you see lots of jerky movements in equity space as well, because people do see treasury yields rising, and then the equities is not rising in tandem in terms of the dividends or their fixed or preferred shares and whatnot. So that's just why some jerkiness in the market. And for people, I think every month or so, I receive some WhatsApp saying that USD is going to die, there's some conspiracy, and China will take over the world. I must clarify that is patently not true. A lot of people still prefer holding on to US dollars. So global reserves in US dollars is still about 59%, very, very high. The nearest to it would be yen and euro at about 20%. So don't think that the US dollar is going to go anywhere anytime soon, because we're in the same boat together, holding on to the same thing, and it's not going to disappear overnight. And China is far, far away from being a significant global reserve held by many countries. I think over this past week, IMF did increase its proportion of renminbi holdings, but it is not very significant. So just to clarify, USD is still the preferred reserve currency for all countries, including Malaysia. And in terms of transaction, anything that has USD behind or in front means USD is being transacted between the two currencies. So on a daily basis, you can't avoid using US dollars because people all use US dollars. And in terms of government bonds, it's still really significant, predominantly in US dollars. So US dollars for the foreseeable future is here to stay in our financial markets. Okay. With the high US dollars, how does it impact us? Well, it makes repayment of interest more painful. As you will have come across in the news clippings the past few years, we had to repay one MDB debt or obligations, and it's painful, and it will continue to be more painful as the US dollar rises. So EM economies will have $1 trillion debt of repayments coming next year, which would cause further problems down the road, not for now. Okay, let's look at the futures. So IMM net speculative positions is just the futures positioning. So a lot of funds, hedge funds, pension funds, whatnot, supranationals, they position themselves for their needs ahead of time because it hedges their risk. So it also gives you a flavor of what the smart money sentiment is like. And over in orange is what the US looks like. So net off, longs minus shorts, people are predominantly long US dollars. And on the opposite side, you have Aussie net short, you have pounds very net short as well. Okay, so this is just one facet of what we view whenever we actually try to make a forecast, how people are positioning their money. And still, we subscribe to the view that people are short, or like they dislike pounds, dislike Aussie still, and prefer US dollars. Okay, so going on to ringgit, I think the main focus will be about USD and ringgit, and I can move on a bit faster thereon. Ringgit is important because we are Malaysians. So let's take a deeper dive into our own data. You would have noticed that we fell off a cliff maybe only in the past month. It was very sharp. Prior to that, we were pretty resilient. And this is simply because China shut down Shanghai, threatened to shut down Beijing, and now that is a bit better now. They may reopen Shanghai pretty soon, but the fact is that we are so influenced by China. China's renminbi is pegged to basket currencies, and within that composition of that basket, ringgit is 4.4%. So not really big for China, but very significant for us. So if you're going to see our forecast and our spot rate for renminbi to China, renminbi to ringgit, you're going to see that actually towards the end, right, it's about there because we don't really fluctuate very far. The most correlated asset class in the world to the ringgit is the renminbi. So to get a gauge of how well we do, actually just look at China. So unfortunately, China is slowing down, despite us doing very well, especially relative to our neighbors. So first quarter, we had 5% GDP, very good. Inflation, very manageable, 2.2% in February and March. We had no need to raise interest rates, but Bank Negara did raise interest rates to 2%. And that's simply because they believe that they are strong enough. Right now, everything looks rosy. So you should do it now instead of when you're pressured or when you have to do it at the very last minute. So that's the thinking. So we did raise interest rates, even though it made it a bit more painful for SMEs. You can see from our industrial production, industrial production is used in Malaysia as opposed to PMIs because they don't like doing surveys for some reason in Malaysia. So taking into account manufacturing, utilities, mining, so we rose 5.1% in March. And our trade balance, which is what actually gets us higher foreign currency, right, or more foreign currency, actually improved in March as well. So everything on paper for Malaysia looks rosy, and logically, ringgit ought to appreciate. And we've been of the view that ringgit should appreciate for quite a while now. So you're speaking to our RMs, we've actually been advising a lot of customers to please come back ringgit, come back ringgit. It makes a lot of sense. Reality is that ringgit is nearer towards 440. Now it's about 439 and improved a little bit, but 437.80, and now it's back up again. And one of the main reasons we do notice is that simply because residents in Malaysia themselves personally do not like the ringgit. So we see an increase in FX deposits out of ringgit into foreign currency. And we see some bond sell-off in the market as well. So despite us looking rosy, people are overwhelmed by the global external outlook. So give you some benchmarks for what I've been saying, that actually ringgit is not that bad. So this is performance since say middle of June. And ringgit actually has not been doing that badly. You must always benchmark against something else. You just can't say that, oh, it went up 10%. 10% against what? In what time period? So to give you a proper view, a more accurate view of what's happening, right, you must benchmark it. So ringgit versus our neighbors actually haven't been doing all that badly. We haven't fallen as much as other countries, even though our view of our own currency is so poor. And going forward, we should continue to do decently or well, punching above our weight relative to our neighbors because of the things we produce and export. We produce natural gas, which brings us our highest revenue margins, crude oil, palm oil, all these three combined give us 20% of our total exports. So all been going up. Electronic goods, demand is backlogged for the past 2 years. That's our biggest exporter in Malaysia. So all this combined actually brings us a very healthy trade balance, and therefore that feeds into a very healthy current account. So don't think that Malaysia is all that bad, despite all the negativity you may come across on a daily basis. Bank Negara and Ministry of Finance seem to be doing a pretty decent job. So we actually feel that our current account, which is, well, your profits minus losses or expenditures, right, remains very healthy. No downgrade, the red bar going into the end of the year. So with that, we feel that ringgit is undervalued. At present, market forces are positioning it to go towards 438, which we feel is fair value. More likely right now is about 439.50, more likely to hit 440. But fair value ought to be 438. Rarity eventually will take hold, all this fear cannot last forever. And fundamentals will push the USD down towards a better or more accurate value of ringgit. So our view is that ringgit will continue to appreciate towards the year end, ending at 428, because even at 428, by no means is the ringgit weak. It is still highly undervalued. So most banks across the world also have the same view. So over here in the chart, right, I give you the median of forecast by banks across the world. So most banks do expect the ringgit to continue to appreciate. The purple line is just some proprietary Reuters forecast by their smart star or something, some proprietary quant system they use. So we're not the only bank that is being wrong with the forecast on ringgit right now. And with the ringgit forecast wrong, every other forecast is wrong. So we are one of the most bullish on the ringgit though. Okay, so going forward, move on to euro quickly. I don't think so many customers have euro exposure. Europe is rather stagnant now, even if with our forecasts. We don't think there's much movements between euro. Our forecast is 1.03 for the second quarter. Now it's 1.05. We expect the euro against ringgit to depreciate, even if you're looking from the point of view of appreciating ringgit. There isn't all that much happening for Europe. They are bogged down by what's playing out in Ukraine. So the ECB has been refusing to talk about interest rates for the longest time. So they aren't one of those very, very hawkish central banks. And they are pretty much being buffeted around by global external factors. So we don't expect much to happen for euro. Actually, we're a bit more bearish on the euro. You can see that there have been downgrades for growth, especially in eurozone, and raise in inflation forecast for eurozone. So give an example why. So in Europe, a lot of people use natural gas to produce electricity because it's cleaner than coal. Coal is one of the cheapest things that you can buy to produce electricity. And for Germany itself, roughly 40% of its natural gas supply is from Russia. So Europe has gone on the path where they actually said, we want to wean ourselves off energy supplies from Russia. And that would be a slight period of pain for them because inflation would rise. You still need to heat up your homes and produce electricity, especially coming towards winter. So among all the countries being affected, Europe is worse off from the war in Ukraine. And probably Statista estimates you're going to shave off 0.5 percentage points from their GDP thanks to the war. On to UK, I think is a bit more important for our customers. A lot of customers have exposure in pounds and Australian dollars. So if you look at the data for UK actually looks very, very healthy. Everything looks good. Even forward-looking indicators like manufacturing services looks pretty good. The services sector in particular has been the one that's been feeding to a very strong first quarter GDP. It was up 9.9% in the quarter. So that's why your GDP is up 8.7%. But you look deeper in March retail sales, people have been slowing down their purchases. And that's unusual. And it also hints at the problem that the UK is facing right now. With the high inflation and your wages not rising in tandem, their wage rose about maybe 5% on average the first quarter. You have the real worry that your real income is diminishing. And that's why people are spending less. The Bank of England raised interest rates last week on Thursday. And in tandem with that rate hike for the third time, they kept giving warnings that the UK economy will face a very tough time going forward, probably shaving off 1% in the fourth quarter and shrinking. They use the word shrinking in the next year, which actually implies that they may face a recession in the next year. And usually recession encompasses nasty words like high unemployment and high inflation and whatnot. So that is the reason why the pound hasn't been doing all that well. It actually fell off a cliff as well, because the Bank of England keeps being so negative about their own economy. And when you have the market already pricing in so much bullishness, the past 2 years when we had the coronavirus, despite the coronavirus, right, the pound actually was very strong. So much of it has been priced in already. Now when reality is finally kicking in and the Bank of England is willing to take a more firm stance, on guiding the expectations of the population. That's why you see the pounds falling off. And we do expect the pounds to continue on that trajectory to come down versus the US dollars, now roughly 123, 122 year end. But against the ringgit, more significant because ringgit is undervalued. We expect it in the second quarter to come off to 531. Right now, it's about maybe 500 pips above that. So there's some room for it to fall further down. So we are bearish on pounds. So if you do need pounds, our general advice is the fundamentals, the evidence before us tells us is that the longer you hold off, the better off you are. We always of the view that things will get better eventually. Okay, so diving into some of the data which was given to you or shown to you earlier. So wages falling, consumer confidence falling along with it, and among the developed countries, the UK actually is the worst off relative to expectations. So the red line, sorry, is the UK. And this is weekly wages, which is the main concern for people. Moving on to Australian dollars. Australia hasn't been doing fantastically well when traditionally it has. It did benefit from a huge rise in commodity prices earlier part of the year, but that's fallen off because of China. China is slowing down pretty dramatically, but things are looking hopeful, a lot more hopeful than they did, say, 1 month ago. Unfortunately, China will still play a huge role for how Australian dollar reacts. The RBA raised interest rates earlier this month, the first Tuesday of every month, except December. It barely made a blip in Australian dollars. It rose a bit and then continued to fall. Market is really bullish really hawkish on the RBA. They expect the RBA to hike interest rates by another 250 basis points, which is 2.5% by end of the year. But they probably will be sorely disappointed because the external outlook looks pretty bad. So that's one of the main reasons why we feel Aussie will be coming down and below 3 again. The RBA hinted they will raise interest rates again in June, first Tuesday of June, which is pretty soon around the bend, which will bring up their interest rates to, say, 0.6%. One problem about that is that as they raise interest rates, they make it very painful for their population, because currently their population's household debt to income is 186%. So what drives the Australian economy is service sector catering to the mining industry and housing. We can see that the amount of immigrants actually move to Australia, or even a lot of Malaysians who desire to move to Australia, right? Actually, a lot of us do want to do that. And every person that goes there, what's going to do? Going to buy a house, going to buy a car. So that's why loans is such a big thing and such a big business for Australia. So the overall outlook for Aussie doesn't seem too comforting. And you can see that, as I mentioned earlier, they benefited from a rise in commodity prices, but their biggest buyer is China. Australian dollars is literally a liquid proxy for the health of China. So with Aussie actually kind of meandering downwards, it does reflect exactly what is happening over in China right now. So Australian dollars looks pretty uncomfortable at present. Recent uptick in GDP was driven by consumer demand, but consumer confidence, which is also a leading indicator to consumer spending, looks bad. So probably Aussie would need a cheaper Aussie dollar to help its country. Okay, and the other big currency which we all tend to love is Sing dollar. Singapore dollar has done extremely well, as we actually did expect it to. Simplistically, without all going through all the data, right? This is what drives the Sing dollar. This is the trading band which Singapore uses, or this is what we assume is the trading band that Singapore uses, because they don't reveal their composition, so we have to kind of guesstimate what the composition is. It's traded against a basket of its biggest trading partners, and recently, you can see that the MAS has allowed the Singapore dollar to trade on a higher channel, a upward sloping channel. And the reason is because Singapore doesn't use interest rates to curb inflation. I think you'll barely make a dent because people are rather well off there, even teachers and policemen. So you probably won't curb much spending if you use interest rates. And you have so many foreigners. So logically, you want to use foreign exchange, right, to kind of cap spending. So with that rising inflation across the world, they decided to let the Sing dollar appreciate, or maybe more accurately, force the Sing dollar to appreciate, because this is the floor. So at some point in time, right, you're going to have the floor keep rising, rising, rising. So you keep having a higher Sing dollar. So presently, Sing dollar is at 317. When all this started prior to MAS, Monetary Authority of Singapore, raising their trading ban in April, the Sing dollar was about 302. So you can see that it's a sharp rise already. So the Sing dollar is second only to the US dollars. And we feel that it will continue to appreciate. So over here in the chart, right, and sloping down, that's simply because it's USD on the left than Sing dollar. So that means that Sing dollar is to appreciate. So fair value though for us against Sing dollar in second quarter is 315. Now it's 317. And again, it's simply because we feel ringgit is undervalued. So if any RM were to trade and ask what's the strongest currency at present, usually I would say USD followed by Sing dollar. Then third choice usually is please come back ringgit, because at the end of the day, you want to sell high and buy low, just like how Warren Buffett makes his billions. Sell high, buy low, or buy low, sell high. And that is exactly ringgit for you. We do look rosy on paper. It makes sense to hold ringgit. And we are raising interest rates up. So it actually helps the deposits. And for the last currency, I'll talk about renminbi. Renminbi is all about China being shut down. You can see the forward indicators for their manufacturing and services sector is contracting. So this is below 50, it's contracting. And not only that, red means that it's contracting at a faster pace. So it's decelerating the economy. And recent data that came out on yesterday pointed to even more painful activity in China. Their industrial production, which is the measure of their output, fell by 2.9%, and their consumer spending fell by 11.1%. So all very, very ugly data that came out. And that's one of the main reasons why Aussie and Kiwi fell off quite suddenly. So going forward, what's going to happen? Hopefully, they will reopen Shanghai soon. It seems like likely they will do that. There's been they've had their third day of no COVID outside quarantine zones. And the central bank has been, I think on a daily basis, trying to comfort their own people. They're going to lower interest rates and stimulate the market, particularly for tech sector and manufacturing sector. So there's some stimulation happening there, and recovery will be on the cards. So hopefully there's a bottoming out there. Otherwise, we do not recommend people to punt on renminbi unless you need it. So why is there inflation across the world? Because of logistics. China is such a huge player in a global supply chain. And with Shanghai being out of the picture, you have a huge port, a lot of orders not being sent, and rising costs of delivery. So you can see the impact it has, and you can actually have an idea of the impact it has on Malaysia itself. So China is really important. And with China, or at least the renminbi going down, so ringgit has been impacted as well. We are the most sensitive to changes in renminbi. Okay. Lastly, is gold. Gold is just a safe haven. And people are now preferring US dollars to gold because on the opposite end of gold, we trade US dollars. So we don't think too highly of gold as an outright investment. But for diversification of a portfolio, I think Really, every fund manager would recommend maybe 1%, 1.5% of your portfolio on gold because it does rise along with inflation. Our target is 1820 towards year end, and it's kind of gravitating towards that value right now. I think fear is probably going to recede here on second half of the year. Things would be getting better, and then we will probably see gold falling in tandem with that. So this is our overall forecast for our bank on the left side. So this is extracted from Bloomberg, so not all that bad. You can refer to it just to have an idea of how we feel. On the right side, to give some relative benchmark, I've actually given the mean of the 25 biggest banks in the world. So this is our forecast versus 25 biggest banks in the world averaged out. So this is what we expect going forward. We expect, well, everything to fall against ringgit, with the exception of Japanese yen. So ringgit is undervalued. But if you want to buy pounds, Aussie, euro, or Kiwi, or Sing dollar, we feel that you get a better deal by waiting it out going into the rest of the year. And you can actually receive this in the RM. If you request for it, we'll email it to you just for your reference. At least you can have an idea of how we feel. And with that, I am done.
Thank you, Marcus, for an informative session. I think we can now kick off the Q&A session. We'll start with probably $1 million question in most people's mind. So recently, there's been reports that Malaysia should once again peg its currency at 3.8. What are your thoughts on this, since you did mention that the ringgit was undervalued earlier?
That is an opinion of Mahathir Mohamad. So yeah, it's one person's opinion. I don't think anyone has actually voiced support for that. Not too sure if a lot of people will benefit. Maybe the upper and middle income class would benefit because honestly, on average, majority of Malaysians don't even earn enough to pay taxes. So why would they care about foreign currencies or spending it overseas or buying properties overseas? So back in, I think, 2016, about roughly 13% of our population pays taxes, of a working population of, say, 12 million. That's not a lot. So why would they care about, say, foreign currency? So why would you want to peg it? I think the main winners would be banks if they actually did peg it. And you can actually see this reflected in the statements coming out from Bank Negara. Every statement, every memo that comes from Bank Negara has 4 paragraphs. And there's no emphasis, or at least no emphasis on the weak ringgit. Never. We actually been rather happy on the weak ringgit. And it actually helps our trade surplus. So much so that the US Treasury has given us warnings for several years that you are manipulating your currency. So it seems like we are comfortable with our lower ringgit. It actually does kind of prohibit our Malaysians from going overseas as well. It just keeps spending within Malaysia. So yeah, it was just an opinion on one person now. So now I'm giving you my opinion on that now. So very, very unlikely.
Thank you, Marcus. So I guess with that also, you don't foresee a repeat of the 1997 to 1998 currency crisis situation for Malaysia?
No, it's totally different for different reasons. We had our fundamentals out of whack back then, really, really out of whack. And we were just on this tiger phase and we were swept up with it. And some rich guy decided to take advantage, but all the fundamentals that we have now, like stress tests in Malaysia, banking sector across the world every year, we have emphasized so much on risk management from then on. You'll probably never see such a problem again. You have other problems, stagflation and whatnot, but you won't have such an Asian financial crisis ever again.
Okay, thank you, Marcus. Earlier, you also talked about persistent geopolitical tension, ongoing supply chain disruption, a slowing Chinese economy, and a hawkish Fed. So with these themes in mind, what would your favorite currency for portfolio diversification be, assuming a 3 to 5 year timeline?
Let me give you what people are doing. The smart money they're positioning. They're predominantly positioning in money markets, very, very liquid assets, short-term treasuries, even outright currencies itself. So that seems to be the flavor. The 2 main currencies that have been benefiting is USD and yen, not even Swiss francs. But we don't know how long that lasts because we do prefer to see value based upon fundamentals, not based upon sentiment. So that's why I gave you some clarification that geopolitical tension short term, I told you at the very beginning, is very murky to give you a forecast because you're all swept up by this extreme panic in the market because we can't see beyond the next year. We don't know what Russia will do when they're not. Okay, they're trying to phrase this nicely. They're sometimes deceptive, oftentimes deceptive. So it's not really clear cut what will happen in that part of the world. And definitely it's really causing a food crisis. A lot of countries in the world have food security problems right now. So that probably will be the next crisis we face. Food and water shortages, more so than say some financial market breakdown. Yeah.
Okay, thanks. And also, since we're talking about the Russian-Ukraine invasion, with some countries or with Russian rubles now being accepted in all transactions, and also yuan to a certain extent, do you see these sort of eroding the reserve status for the dollar?
No, they're not acceptable in all transactions. For rubles, it's been kicked out of SWIFT, and renminbi is transacted on a swap basis still. So it's actually limited. So both countries aren't freely traded right now. We would prefer to see more concrete fundamentals before we would ourselves prefer to get rubles or renminbi. So it's best to not punt because foreign currency more often than not will burn you. I think you will receive lots of ads to trade currencies, but most people will show you their profits and they'll show you their losses. It's really a bad idea. So for us, generally in GM Treasury, we only propose currencies you need. If you don't need it, then please don't buy it. Don't punt, please. So I stand by that.
Okay, thank you, Marcus. And also, we have a question here. Can you briefly share on the New Zealand dollar? And would the performance sort of be comparable to its neighbor, Australia?
Yeah, so actually I kind of skipped by showing you slides from Kiwi just in the interest of time. So I was a bit 3 minutes overboard. But Kiwi, even if you actually try to scour the net to look for news on the Kiwi dollars, there isn't all that much. That's simply because they're just so influenced by what happens in China. Whenever you talk about Aussie, right, you always lump it together with Australian dollars because they're so lumped together. Their trade profile is dissimilar because they have a lot more agricultural products, for example, timber and whatnot. So not so much reliant on mining, but a lot of it still goes towards China. So one big difference is that the New Zealand government is very hawkish. They want to raise interest rates. Unfortunately, the market has already expected that and priced it in, just like the UK. So that's why you don't see all that much rise in the Kiwi. And ultimately, you need China to be humming again and the global trade to resume before you can see significant rises of significant gains in the New Zealand economy. So it's just being bounced around by external factors right now.
Okay, thank you, Marcus. And since you spoke a lot about the recent dollar strength, do you see how long do you see this bull run sort of going on before it stabilizes, especially against the ringgit?
Oh, that's very hard, man. So when you veer towards forecasts, the further out you go, the murkier it gets. So the most accurate answer I can give you right now is that at least for the next few weeks, USD will remain strong. But beyond that, I will clarify, it gets murkier and murkier. And how do we kind of guess forecasts? We like to use technical indicators. Recently, the flavor for a lot of banks, including HSBC, is to use machine learning, looking at technical indicators in bonds. And you will see our forecast for ringgit. Actually, the ringgit will appreciate. But actually, the reality is that flows and sentiments dominating so much. The next few weeks, at least, US dollar will be more likely to hit 440 than to go down to its target level of 438. So, what I would tell a friend if they ask me this, right, without the restrictions of compliance on my back, is that it's probably going to hit 440, which is a major resistance level. Then more likely than not, based upon that resistance level, which happens to be 2 standard deviations on a daily basis. So it's more likely to bounce off and come back down again. So we use technical indicators, lots of charts, and the charts actually is just a graphical representation of mathematics, statistics. So based upon historical, there's like 2 SD charts that actually revert back downwards. So if a friend would ask me that, it's probably going to hit 440 and then come back down again.
Thank you, Marcus.
Yeah.
Now, before I let you off with the final question, can we get you to share briefly on the Canadian dollar as well?
Unfortunately, it's just similar to the rest of the world. All prices have been coming off a little bit. I think it's the most correlated asset class to the Canadian dollar. It's not doing very much by itself. There was, I think a year ago, they were in this interest hike cycle that has fallen off right now. And there actually is very little news coming up from Canadian dollar. Right now, it's roughly 342 against ringgit. We, of course, expect the ringgit to appreciate versus everything, except the exception of yen. So yen targets 324. So just like all the other currencies, we feel we're better off holding off and waiting for gravity to kick in again for the ringgit, because we actually are a pretty strong country. Okay.
All right. Thank you, Marcus. So I think we will wrap up the session today. Thank you so much, Marcus, for your time and for the explanations and also taking the Q&A. For everyone else, I'd just like to thank you all once again for dialing into our call this morning and for taking the time off this morning. We hope you find this session helpful and informative, and we look forward to continuing to serve you. Thank you.
Thank you, Kimberly. Thanks, everyone.
Grow your wealth and diversify your investment on unit trust via the HSBC Internet Banking. Here's how you can invest instantly. Log on to hsbc.com.my/UTB. You'll find more than 80 retail and wholesale funds to choose from, so you can diversify to manage risks. You can even invest in both local and foreign currencies, buy, sell, or switch anytime you like. What's more, you can make fun comparisons with regularly updated market insights. With everything HSBC has to offer, you have total control to diversify your unit trust investments online the way you want it. So invest with HSBC Unit Trust via your HSBC Internet Banking easily today.
Allion, at your service. The global markets, especially the US Foreign Trade Index, is open. More opportunities to invest, more choices. Did you hear about the good news? Check out how much your holdings have grown since the last investment. Great job! Whenever you're ready to make another investment, you can easily invest with just a few taps.
Hi, what's with the big smile?
It's just my wealth planner. This one is with me all the time.
Your personal wealth planner now on mobile. Stay ahead of your finances in just a few taps with Wealth on Mobile. Now available in the HSBC Malaysia mobile banking app. Invest easier and smarter with Wealth on Mobile. Download today.